Wealth Management Advisor, Perspective Wealth Planning. With this week's market breakdown video, we got a lot of great stuff to cover in today's video. We're going to take a look at our 4 major U.S. indexes. We'll look at the dollar. We'll take a look at some commodities. But we have some really interesting data points to take a look at. On Wednesday, we had a huge spike in the VIX. The VIX was up almost 63%. And it's elevated as it already is. So I want to take historically a look at what happens when the VIX jumps more than 40% in a session and is over that 30 handle. What does that mean for stocks historically? We're also going to take a look at margin debt as well as free cash sitting on the sidelines at the New York Stock Exchange to really take a look at what's going on and how much further this market can run based on those historical data points. Well, let's get right into it here. First and foremost, let's talk about yesterday's action. Wednesday stock action across the major indexes was ugly. The S&P 500 finished down almost 3%, gapped down in the morning, and sold off the entire day to close at the low of the day. Now this candle, if we're zoomed in on it, looks really ugly. But when we take a bigger picture, we have not broken any sort of key levels with the action that we had yesterday. All right. The major level that I think is really, really important is right around that 3,600 on the S&P 500. If that were to break, I'd start changing my tune. But as long as we stay up above that, we're above that breakout that took a couple of tries to get for. We're up near those all-time highs. Even if we have a 1 day worth of bad action, it doesn't change the overall charts. We have to keep that in mind. Look at the Nasdaq. The Nasdaq hasn't even closed that gap from the 19th. Even with yesterday's ugly action, it's still holding up over all of its major key support zones. We take a look at the Dow. The Dow is a little bit weaker. We've talked about that. But it's still clearly over that all-important 29,500 level. And even though yesterday's action was bad, it didn't change the charts. If you look at the Russell 2000, the same thing can be said. It has been extremely strong since November when it made its breakouts, continuing its grind higher. Yesterday's action wasn't great in the Russell, but guess what? As I'm filming this here before the market opened on Thursday at about 9 a.m., the Russell is up 1.5% overnight, so undoing a lot of this loss from yesterday. My point being, even though the action yesterday was ugly across the board, it didn't break any charts, it hasn't changed anything, and we're going to continue to pay attention to it, but as it sits right now, no harm really on the bigger picture has been done. Now let's talk about the VIX. Yesterday saw an incredible VIX spike during the action of the day. We actually shot up about 65% on the VIX. We're up over that 30% level, and that is something that historically doesn't happen very often. There's 8 instances in the last 30 years of this taking place, where the VIX jumps more than 40% and is above that 30 handle. And if we look 1 day, 3 days, a week, 2 weeks, a month, 2 months, 3 months later, the market is positive a high percentage of the time. Now, the really ugly action happened last year where we saw a 16% and a 15% drop 2 weeks and 1 month later, and that was during that course of that sell-off that we had back in March. But if we look at a lot of the other times where this has happened towards bottoming areas of moves. It happened there, it happened here. So the question, of course, is, are we going to get what we got 7 out of the last 8 times, or are we going to get what we got 1 out of the last 8 times? And taking a look at everything else that's going on, and we'll take a look at margin debt and some other things in this video, right? Historically, this has not been a bad thing because it is typically tends to mark kind of capitulation, so to speak. The VIX is jumping that high. There's so many people that are buying protection with an elevated VIX already. It can be viewed as kind of that, capitulation zone, and that's why we've seen the market higher over the shorter time frame, regardless of that high spike in the VIX. Now, let's get in and let's talk about the U.S. dollar. Let's talk about some commodities. The U.S. dollar is still, and I'm going to back this out on a monthly chart, just talk about this, it's still fighting in that zone, right? We have not broken down. We have not put in an actionable low. We have not bounced back up, right? We are still in a downtrend, and we're at 10, 15-year support. What happens here is really, really important. The dollar doesn't move very fast. We've been talking about this for a while. This could still take a couple of months to ultimately play out, whether we're going to get that move up or down. We're going to wait patiently, and we're going to continue to stay on top of it because I think it has huge impacts across the board with what happens here. As such, let's take a look at commodities, right? Gold still holding above that zone. All right, we don't want to see it if we're really bullish. We don't want to see it below 1800, and we definitely don't want to see it underneath 1750. Gold has gone nowhere in 6 months now after the huge run up in the beginning of last year. To get this space going again, I think we're going to need a resolution on the U.S. dollar, more than likely. Silver has continued to act stronger, right? It's more up towards those highs than towards the lows in terms of the last 6 months trading range, but it also hasn't really gone anywhere in a while as well. So we're continuing to watch that space. When we take a look at Palladium, Palladium still is not back up over that 2500 level, has done really nothing over the last 6 months. We're continuing to watch that. Platinum, on the other hand, right, it's still trending higher. It's near the highs for the last 5 years as it sits right now. It did not pull back the same way that gold and silver did. In fact, actually, it's continued to push up. It's because it has had a much tougher time over the last decade. So here we are. We can see that major level. I want to see it up over 1200 so we can get that move back up to that 1500 zone if we were to get over that area. This is one of the more interesting metals that I'm paying attention to at the moment. We'll take a look in at copper. Copper is acting well, holding up, right? Broke out and is holding up. We'll back this out and look at it on a monthly chart, right? These are, about a decade highs that are put in here, and we've talked about this zone right in here as being that next area of resistance a while back at 380, and then really it comes in there up at 450. So we're going to continue to pay attention to what goes on in the copper space. We'll take a look in at crude oil here. Let me get some of these drawings out of the way. As you guys can see, we're right up into that resistance zone of 55, but this is just acting as a potential bull flag at the moment, where we could have another push higher here. We're watching to see if we can get up over this zone, but it's been good action in the space after the historic crash from last year, and it's really just kind of gotten into this grind higher mode over the last few months, and so that's worth paying attention to as well. Last but not least, we'll jump in and we'll take a look at the emerging markets. They sold off a bit yesterday as well, but again, we're up, broken out, sitting near 7-8 year highs. Some of the emerging markets themselves are 20-30 year all-time highs. We're finally getting some push out of some of these areas. It's an area that we want to continue to pay attention to moving forward. Now let's get into it and let's talk about margin debt. All right, what we've got here is the chart of year-over-year growth in margin debt in the S&P 500, and this chart goes back to the 1950s. All right, and what we can see is we are at about that 20% level year over year, which is a small portion of this chart. All right, we can look at all the red dots up here on the S&P 500 when this happened. A lot of times they are happening and we still have that continued growth. Let's actually look at the numbers behind this. It's interesting. When we take a look at the positive percent, we get out to about a year. 9 months were really, really good. A year we're at about random. And then 2 and 3 years later, we're back towards that 50% zone in terms of the market being higher. One of the reasons why you can think about it this way is that margin debt is expanding, which is kind of giving that fuel to the fire, but eventually it runs out of steam, so to speak, and that typically tends to happen when we look at this data set between that 1 and 3 year later mark, where we do have some pretty negative kind of returns a couple of years out. Right, this happened in the late 90s, right in 99, and then of course we had that rollover. This also happened again in 2006, 2007 before we had that rollover, but we still ran for another couple of years. Happened again in the 80s, same kind of thing. Happened again in the 70s, same kind of thing. Happened again in the early 70s, same kind of thing. Right, where we tend to run for another year or two before this kind of backfires, so to speak. One of the other ways that we can take a look at this is also free cash flow. It's sitting on the New York Stock Exchange. So let's take a look at that. I'm going to leave what Jason wrote about this on the bottom here from Sentiment Trader because I think this sentence is very, very valuable. But here's the New York Stock Exchange available cash. We are back near those lows. But as he says here, this can remain low for a long time, and there isn't necessarily any lower level that we need to be paying attention to. But the pace of its shrinkage is alarming. The steep that we've got here over the last year is very, very alarming, meaning, there is not much available cash sitting on the sidelines. It's all getting put to work. Now, as we know, the Fed has printed a ton of money. Cash this year, over the last year, has really changed in terms of its value. And so this might not be as important as people think if we're going to continue to have that unlimited money printing machine going on. So I'll leave it at that for you guys. What I will say is, even though we had a sharp sell-off there on Wednesday, until the market actually breaks below its key levels, a day like this, while it doesn't feel good if you're looking at your portfolio, doesn't change the long-term picture. We'll continue to pay attention to those bigger themes, those bigger trends with cash, with what's going on with the VIX, what's going on with the dollar, and continue to bring that information to you guys on a weekly basis. So if something does change, I will certainly highlight that for you. As always, if you guys have any questions, feel free to reach out to me. You can reach me at mtedeschi@perspectivewealthplanning.com or 814-580-9881. I'd be more than happy to talk anything about the markets with you guys. I hope you have yourself a fantastic week. Take care.